Let's work exercise 1911 from chapter 19 regarding pension expense, journal entries, and statement presentation. So as always, let's read the facts of the problem and then we'll address the questions asked. Exercise 19.11. Henning Company sponsors a defined benefit pension plan for its employees. The following data relate to the operations of the company, operation of the plan for the year 2025 in which no benefits were paid. Okay, so right there we know we're dealing with 2025 and no benefits were paid to retirees. And then we've got four facts. We've got the actual present value of future benefits earned by employees for services rendered in 2025 amounted to $56,000. Let's make a note of that. So number one indicates that basically it's the service cost for 2025 is $56,000. So the present value of the future benefits earned by employees for services rendered this year. So we see the services there, so that's a clue. So that is our employees that are working for us this year that will retire at some point in the future. And we are going to match that cost, those retirement costs of those employees that are working this year. So the service cost for 2025, as stated in point number one, is $56,000. Point number two, the company's funding policy requires a contribution to the pension trustee amount to $145,000 for 2025. So this is indicating that the company, Henning, is required to make a cash contribution to the plan, the retirement plan, and the trustee that's in charge of it. And that amount for 2025 is for 2025 is $145,000. So let's make a note of that. Cash contribution required is $145,000. Point number three. As of January 1, 2025, the company had a projected benefit obligation of $900,000, an accumulated benefit obligation of $800,000, and a debit balance of $400,000 in accumulated other comprehensive income, OCI, for the prior service cost, PSC. The fair value of the pension plan assets amounted to $600,000 at the beginning of the year, and the actual and expected return on the plan assets was $54,000. Settlement rate was 9%. No gains or losses occurred in 2025, and as mentioned above, no benefits were paid. Okay, we've got a lot of facts in this one, so let's go ahead and schedule those out. Now, the first one there is the projected benefit obligation was $900,000 at the beginning of the year. So PBO was $900,000 at 1/1/2025. The accumulated benefit obligation was $800,000. So the accumulated benefit obligation was $800,000 at the beginning of the year. And quickly, the difference between those two, the projected is based on what we know today, projecting those obligations into the future. So it does consider increases and impacts of future changes to employees' retirement options. Once they retire, it's going to be more expensive. So there's an increase. The accumulated benefit would be as of today. If everybody retired today, what would they pay? What would we owe? So one is casting that obligation into the future, which is the projected benefit obligation, and the one that is examining it as of today is the accumulated benefit obligation. So continuing, we see that there's a debit balance to the accumulated OCI for PSC of $400,000. So the accumulated OCI for PSC is a $400,000 debit at the beginning of the year. Moving along, we see the fair value of the pension plan assets amounts to $600,000. So the pension plan assets were the fair value $600,000 at January 1st, 2025. The actual and expected return on those plan assets for the year was $54,000. And the settlement rate is 9%. And no gains or losses occurred and no benefits were paid. So no gains, losses, and no benefits paid. All right, so we've captured the comments out of point 3. Let's move to point 4 now, summarize that. So amortization of prior service cost was $50,000 in 2025. Amortization of net gain or loss was not required because, again, as we noted, there was no gain or loss, so that's not a surprise. So amortization of prior service cost was $50,000 for 2025. Okay, so we've captured the facts of the problem. Let's now move and see what we need to answer. So we've got 3 requirements for this. Part A asks us to determine the amounts of the components of pension expense that should be recognized by the company in 2025. So we want to be able to capture what are the components of pension expense for 2025. So let's schedule that out. So the first one we have is service cost. Always start with the service cost. And we noted that above in point number 1 was $56,000. Okay, next, let's consider the interest on the projected benefit obligation. The interest on the projected benefit obligation is a function of the projected benefit obligation, which is $900,000, given to us in point 2, times the settlement or discount rate. And that was also given, that was given to us in point number 3. And that is also, as stated above, 9%. So the PBO from point number 3, $900,000, times the settlement or discount rate, which was given to us in point number 3 at 9%, gives us $81,000. Next, we want to take the expected return on plan assets. And that was given to us also in point number 3, and that was $54,000. That's going to reduce the expense. The more profit / return we make on our plan assets is it lowers the amount of total net pension expense. If it was a loss, it would increase pension expense, but we did say that we had a return, so we're going to presume that's a positive return of $54,000, and that's going to decrease, so I'm going to subtract $54,000 for the return. And the last thing I need to consider is any amortization of prior service cost. And that was given to us in point number 4 of $50,000. So that's going to increase my current period pension expense by $50,000. Therefore, based on this calculation, my total pension expense for 2025 is the total of $56,000 plus $81,000 minus $54,000 plus $50,000 is $133,000 total pension expense. So that is my answer for number 1, part A. Let's take a look at part B. Part B says, prepare the journal entry or entries to record pension expense and the employer's contribution to the pension trustee in 2025. Okay, so B is to prepare the journal entries. Okay, let's start with the, it does say entry or entries. I'm going to go ahead and do all of these in one journal entry. You could, of course, break them out, but given that they all interrelate, I'm going to do this as one journal entry. Okay, so we're going to have a debit to pension expense, and that is going to be the amount we've identified above, $133,000. And then I'm going to either have a debit or a credit. I don't know yet. Let's investigate. Debit or a credit to the pension asset / liability. I don't know what that is at the moment, so I'm not sure if that's going to be a debit or credit. I do know that cash is going to be a credit. Cash is always going to be because we have to make payments to the plan. So debit cash, and up above, we saw that that was number 2, cash contribution, $145,000. So a credit to cash of $145,000. And then I need to adjust the balance of the equity account, other comprehensive income, prior service cost. So I will credit that account for the amount that I amortized, credit OCI for the prior service cost. Again, that is an equity account. On our balance sheet, and that is $50,000 was amortized, and the debit side of that is inside the 133. So here's the debit to, which is part of the debit to pension expense of 50,000. Well, where does the corresponding credit go? The corresponding credit goes to that equity account for other comprehensive income, $50,000. And then the net of all of this is my adjustment to the pension asset or liability. And we're going to prove that out as we work through the problem. We'll see this number arise again. So I will take my credits, 145 plus 50, so that's 195, minus what I've already debited of 133. That should leave me with a balance of 62,000. So I have 195 in debits and 195,000 in credits. So this is actually going to be a debit to the pension asset or liability. I don't know if it's an asset. I don't know if it's a liability at this point. We haven't investigated that yet. So we'll have to see if that's actually an asset position or a liability position. Either way, it's a debit to that account, 62,000. So this is our journal entry for Part B. So we're now done with Part B. Let's move to Part C. C says, indicate the amounts that will be reported on the income statement and the balance sheet for the year 2025. So C is to indicate the balance sheet and income statement amounts for 2025. Okay, so there's some things we're going to need to identify. We'll need to identify what is the total pension expense. So we'll divide that between operating and non-operating or other components. We'll need to work on total comprehensive income on the income statement. We'll also need to work on the balance sheet presentation and to determine if we have an asset or a liability position. And remember, we'll adjust that by 62,000. Then we'll see what is our new projected benefit obligation, what are our plan assets, and then what is the new net pension liability. So for us to be able to find these amounts, let's first put together a partial worksheet for the pension items. So let's prepare a partial pension worksheet. You do not have to do the whole thing to be able to find these amounts. So we'll just put together what we need to. Okay, we'll have our balance at 1/1/2025. And we want to track two things. We'll track the plan assets and we'll track our projected benefit obligation. Let's fix some formatting here. Make this font a little smaller so it will, there we go. All right, so our plan assets at January 1st, that was given to us in the problem. Let's see, pension plan assets at the beginning of the year was $600,000. Okay. And the projected benefit obligation also given to us at the beginning of the problem, point number 3, the PBO is $900,000. So if we net these together, shrink these down, and we'll take PBO minus plan assets. And that will give us if we were in a liability or an asset position. So if we take the difference of these two amounts, 900,000 minus 600,000, so our obligation or our liability is $900,000. However, we only have assets of $600,000. So what that means equals the pension asset or liability. So the projected benefit obligation minus the assets we have will tell us what is our pension asset or liability. So at the beginning of the year, this is a pension liability of $300,000. And then the year went along and some things happened. So let's document those items. We have service cost. The service cost affects the projected benefit obligation. Obviously, as our employees are working for us, they're earning the right to retire in the future and earn pension benefits. And that cost for this year was the service cost of $56,000. And we had that right here. And we noted it from point number 1. Service cost was $56,000. So we'll add that to the projected benefit obligation. We also have the interest on the projected benefit obligation. Let's just schedule those down right here. 56,000 service costs. The interest from that journal entry, we calculated that to be $81,000. Let's see. Actual return is the next thing we need to focus on. Actual return on plan assets. And that's going to increase the amount of the plan assets. It does not change the projected benefit obligation, but it does increase the plan assets. So I need to turn that 54,000 into a positive number. So add the 54,000 for the actual return on plan assets. And then we need to consider our cash contribution. And that was $145,000. That's going to increase the plan assets. So what we're doing in this partial worksheet is I'm trying to determine what impacted the plan assets, what impacted the projected benefit obligation. So the plan assets, which are in custody and under the control of the pension trustee, which is not the company, this is a separate party that is in charge of managing the pension plan. They have invested the $600,000 from the prior year, and they earned a return of $54,000. So this would be stock appreciation, bond dividends, bond interest received, dividends received on any stocks, etc., that they invested the $600,000, and they earned a return of $54,000, which is the 9%. Then we also put in new contributions of $145,000. So if we take what was the plan investment at the beginning of the year, $600,000, plus the return earned on that investment, $54,000, plus any new investments of $145,000, we know that there's no benefits paid. So there's no cash payments, no retirees that received benefits. The problem told us that multiple times that there were no benefits paid, so that's a 0. So then that will give us with what is the balance at the end of the year. And so if we sum those amounts together, we find that we have $799,000 for plan assets. Then let's move to the projected benefit obligation column. So our PBO at the beginning of the year, what we think we're going to have to pay in the future as our employees retire, that calculation arrives at $900,000 at the beginning of the year. Then during the year, our employees work for us, and so they're going to earn retirement in the future. That's $56,000. And then due to the increases in cost expected when our employees retire of $81,000 as an added addition to the benefit obligation. And so if we take those three numbers and sum them together, we arrive at $1,037,000 as our new projected benefit obligation. Now you might ask, what about the $50,000 for the amortization? That is not affecting the current adjustment to PBO because that was adjusted in a previous year. So we are just amortizing that through the expense in the current year, but the projected benefit obligation was changed in a prior year. So there's not an impact to this partial worksheet for the $50,000 amortization for the current year, as it was just a carry forward from the previous year. It does not affect plan assets, and it does not affect current year 2025 projected benefit obligation. So just like we did above, let's calculate the difference of the PBO less the obligation less the assets set aside, and we arrive at $238,000. The liability is bigger than the asset, so this is also a liability. Okay, so now we've got some facts here. We're now ready to prepare the disclosures that would be required on the income statement and the balance sheet. So let's start with the income statement. All right, so our income statement disclosures, we would have a line called income statement on the income statement called operating expenses. And inside of there, we will have an account called pension expense. Now, this might be included under employee benefits or employee payroll or employee cost. So whatever line that our company uses, we would have that pension expense as part of our operating expenses, such as salaries and wage expense, employee cost, employee benefits, whatever that line is on the income statement here. At least you may find the line for pension expense, but again, that could be or salaries and wages or employee cost. We'll see what the company uses. And we found the current year operating, this is the operating section, that is $56,000. It's the service cost for the employees that are working for us today. This is an additional expense related to those employees, just like payroll tax. Now we have an additional expense, which is their pension. Next, as we move down the income statement, we'll have this, we're looking for this section, other income or expense. This may be also called non-operating, but it'll be in the other section. So we're continuing down the income statement. We're now down into the other / miscellaneous / non-operating. And we'll have another pension expense. And we can define that as other components. So what else is included in our pension expense? So if we go back to how we calculated the pension expense, the total pension expense for 2025 from Part A was $133,000. $56,000 of that is related to operating expenses. And the difference, these other three, are related to non-operating. The $81,000, the $54,000, and the $50,000 are not related to current employees. The PBO, that is not employees. The return on plan assets, that's not tied to employees. And the amortization of prior service costs, that again is not tied to our current employees. So I'm going to take the total pension expense of 133 and subtract it from what we called employee current cost of 56,000, the service cost. And we get $77,000. So those would be line items that we may see on our income statement. And our total expenses that are recorded on the income statement, $133,000. We're just separating it between operating, which are current employees' efforts, and their $56,000 for pension, and other items, which is the other $77,000 of pension expense. Moving on down our income statement, we'll come to this section. We don't know net income, but we'll come to a section for the comprehensive income statement. So we're down near the bottom of our income statement, and we'll have net income. We don't know what that is. because it's not given to us in the problem. But whatever that amount is, as we were to work our way down the income statement, we arrive at net income. And then we come to the section for other comprehensive income. And as it relates specifically to our pension plan, we have that amortization. Amortization of prior service costs. And we recall that that is $50,000 right there from line 17 on Part A's journal entry, $50,000. And we will add that in to net income, and we'll arrive at final total comprehensive income or loss. And it would be a summation of this plus this. Since net income is unknown, this is basically just $50,000 more. So whatever that would be to add that to comprehensive income. Okay, so that's our income statement. Now let's see, what would we see on the balance sheet? All right, so the only thing that will be disclosed on the balance sheet will be the net pension liability or pension asset. So that asset or liability account. Since we're looking here, we know on line 38 that we have a liability. So let's go ahead and add that in. That will be under our liability section. We will have a line item called pension liability. So you'll have accounts payable, then you'll have accrued expenses, then you'll have interest payable, taxes payable, pension liability. So this will be inside of our liabilities. And we found that to be $238,000. Moving down to our owner's equity section, there are some disclosures here related to that prior service cost. So we'd want to, this could be on the balance sheet. You may want to put this, or you could put this on the owner's equity statement. So since it did not ask for the owner's equity statement, but only the balance sheet in Part C of the problem, we're going to go ahead and roll forward this accumulated OCI related to the prior service cost. So at the beginning of the year, this accumulated OCI prior service cost, I believe it was $400,000. Accumulated OCI PSC was a debit $400,000 at the beginning of the year. Okay, so that's a $400,000 debit. Then we amortized it during the year. And if I recall correctly, that was $50,000. Let's look at our journal entry. Yep, so we credited the accumulated OCI prior service costs. Remember, we said this was inside of equity of $50,000. And a credit is going to change that to, let's change that to a negative. So that's a credit. And then we arrive at accumulated prior service cost, other comprehensive income at December 31st, 2025. Just net those together. And it's $350,000. I'll add some underlines here to show that that was a calculation. And that's a debit. And that will show our balance sheet. All right, so that it does conclude what's required of the problem. I'll scroll through Excel again so you can see what we've done. Lines 2 through 11 capture the facts of the problem. So we read the problem, steps, points number 1, 2, 3, and 4, and we just scheduled out a summary of what each of those points said so that we could easily refer back to it. Then for Part A, starting on line 13, we calculated what was the total pension expense for 2025. And it asked for the components. So there are 4 components: service cost, interest on PBO, expected return on plan assets, and then the amortization of the OCI prior service cost. And we found total pension expense to be $133,000. For Part B, it asked us to prepare the journal entry or entries. So we started with that $133,000 of pension expense. Then we looked for our cash that was paid. We looked for our amortization, the prior service costs. Those were $145,000 and $50,000 respectively. And the net of all of that resulted in $62,000 adjustment to the pension asset or liability account. For Part C, we wanted to disclose the amounts that would be reported on the income statement and the balance sheet. Stop real quick. Look how much the pension plan assets changed by. The pension asset / liability. You see that's a $62,000 difference. 300,000 minus 62,000 is 238,000. That's the 62,000 right here. That's where that came from. So we verified that. We started Part C with preparing a partial worksheet so that we could find the amounts that we needed. We're reconciling all of that, and we see that we actually have a liability of $238,000. So once I credit last year's $300,000 liability, debit last year's $300,000 liability, I'm left with a liability this year of $238,000. I did the income statement. I broke out that $133,000 of pension expense between operating activities, which are current employees, service cost, versus everything else, the other components, which was the other $77,000 of the $133,000. Then I went down and showed the users the components that relate to other comprehensive income, and that's the amortization of $50,000 of prior service costs. Next, we move to our balance sheet. We've already determined that this would be a liability and not an asset. Had that been an asset, it would have been recorded as a pension asset instead. But we do have a liability, as we saw in our partial worksheet, of $238,000. I then moved to the equity section, and we calculated the amount of other comprehensive income to be $350,000 at December 31st, 2025. That would also need to be disclosed in the balance sheet equity, owner's equity section. So at this point, it does conclude the calculations to solve exercise 1911 related to pensions.